we saw attempted to be slowed pretty heavily in 2022, for example, when the Fed started their initial very hawkish activities, and it started to reaccelerate roughly by the end of the year, and especially in early 2023. One of the things I've been highlighting in my research is that right now, one of the levers that does somewhat slow it are the tariffs. That basically represents, at least at a current kind of monthly basis, the biggest tax increase in a very long time. And so that actually does somewhat reduce the near-term deficit, not by cutting spending, but by increasing taxes. Now, the numbers are still smallish, even though we're talking giant numbers here. So when you look at, say, the U.S. economy is $30 trillion GDP. Annual spending by the federal government is over like $7 trillion. Their income is like over $5 trillion. So you're talking about a $2 trillion deficit delta. And the tariffs are raising hundreds of billions of dollars at an annualized basis. We'll see how long that is sustained, if the volumes kind of change based on some of those numbers. But it's not necessarily that the train accelerates every year. It's more about the unrelenting nature of it. So sometimes it slows down a little bit, sometimes it reaccelerates. For example, the Big Beautiful Bill kept it going pretty strong. If anything, it gave it a minor extra push, but then the tariffs kind of pull it back a little bit. And so the main point is that deficits as a percentage of GDP remain historically elevated. And while they can go up and down maybe a couple hundred basis points, they're pretty locked in. There's very little that can actually stop it. Yeah, the interest expense is one of the key levers that changed. So a lot of people ask, what changed? I mean, people have been talking about the debt and the deficit for decades. It's kind of infamous at this point. People in the late 80s, early 90s, it kind of reached a crescendo in American politics. That was kind of the peak zeitgeist for it. For example, the famous national debt clock went up in the late 1980s. Ross Perot ran the most successful independent presidential campaign largely on this topic in the early 90s. And that was kind of the peak period. If you look at it up, that was actually the peak level of interest expense as a percentage of GDP. Because they still at that time had pretty low debt to GDP, but it was combined with very high interest rates. Now, what they didn't really foresee, and the reason a lot of these people were 30 years early in their alarmism, was not because the problem didn't happen, but because it happened slower than they thought. And one of the main reasons was they opened up China to the rest of the world starting in the 80s. The Soviet Union fell in the early 90s, and that whole block opened up to the world. So you took Western capital, Eastern labor and resources, combined it together, very disinflationary. That was beneficial for interest rates to continue falling. So we had this 40-year period of falling interest rates, which really kind of minimized interest expense. If you double your debt, but you cut your interest expense in half and you keep doing that, it's sustainable. And the problem is we roughly, the whole Western world hit zero. In some places it went negative. Yeah, in the US it went borderline zero, depending on what part of the curve you're looking at. And so now if we're merely in a choppy sideways pattern going forward, which is less extreme than that kind of negative or zero yielding environment, because now the bond market is more demanding of some yield, and because the realities of this fiscal situation are understood, that's one of the key levers that changed, along with demographics and some other factors that make this kind of the past 5 years or so different than the past, 40 years that came before. Yeah, I think, any administration generally has different voices in it. It's the typical thing where there's a king and a bunch of advisors trying to get the king's ear. This administration had more of the pro-tariff side versus the more free trade and cut side, which was kind of the Musk side of it. Obviously, I've been kind of vocal from the beginning that DOGE would be ineffective at doing major cuts because they weren't going after the main areas. They didn't really have the authority to go after the main areas, which are interest expense, Social Security, Medicare, defense, veterans benefits. You can kind of add that to defense. That alone represents by far the biggest piece of the pie chart. Everything else they were going after was the other 15 to 20%. So even if you were to somehow meaningfully reduce that 15 to 20%, let's say you cut a quarter off of that, there's really not a ton. You're kind of picking up nickels in front of the steamroller. So yeah, they have pivoted more toward that running hot, keep interest rates low environment, which is what we saw the last time the US was in fiscal dominance, which was the 1940s. That is kind of the main thing going forward. And I think right now, I guess one of the surprising things to me is the speed of the pivot toward tariffs, which is that they got a pretty significant chunk of people to be really happy about tariffs. So when the government says, hey, look at all the hundreds of billions of dollars we're raising from tariffs, this is winning. It's well, if you actually look at who's paying this, it's mostly Americans so far. It's challenging because we're in a very politicized environment. So if you're just trying to analyze just nonpartisan what's happening with the numbers, if you're just trying to look at the numbers, people can have it colored by, people are against it, will look toward one type of source, and people for it will look at another type of source. But we can look at things like, for example, import prices are measured pre-tariff. They're not down in aggregate so far. You can look at, for example, consumer prices around the margins for goods are inching up is somewhat complicated by the fact that there was import front running. So businesses rightfully, in Q1, when they saw these tariffs coming, they were like, well, let's just import double our amount. Yeah, and that gives them a few months of trying to keep prices low, see if they can weather through it, because they have other competitors. Nobody wants to raise prices first, obviously, if they can help it, to keep market share. And so there are a lot of complex variables, but right now, the majority of it is being paid by the combination of American consumers and businesses, offset by some front running and around the margins, some lower volumes. The nothing stops this train thesis really had two layers to it. One is that there's so much political gridlock that it's very hard to meaningfully raise taxes or cut spending. And then the next layer below that is that the US is so financialized that even if you somehow did do austerity for a period of time, it would likely slow down the economy and or cause the stock market to have a flatter period, which because our tax receipts are so financialized and thus tied to ever rising stock prices, starts to hurt you on the income side. And what tariffs are interesting is that they kind of found a way to pierce through that first layer, which is that by calling it a national emergency, they were able to kind of bypass that, polarized congressional environment and actually just do a major tax increase, which, if you asked me a year ago, would not have been my base case. So that's why it does somewhat slow the train around the margins, but then it starts running into that second layer. And that's why I think it'll be, if we are having this conversation 3 years, 5 years from now, we will still be in a very high deficit environment, even though the numbers can go up and down a little bit. It costs like trillions of dollars to rebuild a manufacturing base somewhere else. So we import trillions from the rest of the world. We spend something like, the baseline was 80 billion annualized rate of manufacturing construction spending in the US. That was kind of the maintenance cost of a flat industrial base. There was a little bit of subsidies over the past couple of years to build semiconductor facilities. So they, increased that by temporarily 160 billion or so. That's actually currently rolling over. So we're actually gradually spending a little less on manufacturing construction, even though ostensibly to offset these tariffs, you'd have to build stuff locally. We don't see some giant new bursts of new spending, at least compared to the past 2-year baseline. And we don't really see a reduction in aggregate import costs. Now, generally speaking, you'll see kind of people that are more in the camp that the foreigners are paying it. They'll show anecdotes like, hey, look, Japan had a reduction in auto export volumes or something. You'll see these individual cases, but obviously any sort of investing thing is, especially when you're talking macro, what's happening in the grand sense, not what's happening with this one company, this one industry, what's happening across the board. And some months into this, the answer is import prices roughly flat, taxes being raised, it's not really being paid by foreign exporters, and it's somewhat spread between American consumers and businesses and that front running that happened. So I think that any given FOMC meeting is not that relevant. So a 25 or 50 basis point change is not particularly relevant. Now, if we start talking, replacing a Fed chair and other parts of the committee and getting like a 300 basis point cut or something like that, that starts to become meaningful. So magnitudes matter. If we're running at 1 to 2% interest rates, that's a different environment than 400 basis points and change. Now, if you look at kind of the purpose of interest rates, like what the central bank's trying to do, their mandates are unemployment and inflation. But then the question is, what are they hoping to do with interest rates? Why does that matter? And what the Fed mainly does is impacts bank lending. That's kind of the whole purpose of the interest rates. Is in theory, higher interest rates would slow down bank lending by making borrowing more expensive, whereas cutting rates makes borrowing more attractive and you kind of restart the credit cycle. Now, the problem is that when you're in fiscal dominance, bank lending is not the main source of new money creation. So for example, back in the 70s, when, baby boomers were entering their home buying years, which is peak credit formation, we had the highest historical rate of bank lending in the country. And so the money creation was largely led by bank lending with some fiscal on top of it. Obviously, you had the Vietnam War, you had Great Society programs. These were adding to it, but there was more money coming from bank lending. So when Volcker jacks up interest rates, he did meaningfully slow down bank lending. And the problem is that this entire cycle, starting before COVID, during COVID, after COVID, none of this was really caused by excessive bank lending. It was all that really large fiscal stimulus that was monetized. So the Fed is trying to kind of slow down bank lending, which is just not really the key thing here. So their handful of interest rate changes don't make a huge difference in that sense. Where it shows up, if they do a massive cut, you probably get a weaker dollar. You probably get a boom in emerging markets because they have all that dollar-denominated debt that gets relieved. That can cause a, kind of more demand for commodities in general, including energy, which could be somewhat inflationary. Around the margins, they can restart lending to some extent. The challenging thing is that we see them talking as though short-term rates and long-term rates are the same thing, which they're not. So the Fed primarily controls short-term rates. And what we saw is that just because they trim short-term rates doesn't necessarily mean that, like, say, mortgage rates go down. And now, let's say they cut 300 basis points. They just completely kill the short end. There's two outcomes that could happen. One is if people are not getting interest rates on short-term paper anymore, maybe they will bid for the longer end. They'll buy long duration treasuries and mortgages. Maybe they will drive those down to some extent. Or they could say, well, this Fed's not serious about inflation. Why would I want to own the long end of the curve? And they could sell it off. So there is actually unclear how that would play out in fiscal dominance. It wouldn't necessarily lower actual borrowing costs. And the small sample we have so far this cycle is it didn't. Now, whether a bigger one or a second one would, market conditions could change. If you have tariffs and the economy slows down, then maybe you get a different result. I wouldn't want to fully say it wouldn't do it, but they're just not the same thing is the point. The longer end is more set by the market, especially when the Fed's not actively buying and selling a ton of securities. If anything, right now they're trimming their longer end securities and mortgages. I think the Fed is less relevant. It's not irrelevant, but it's less relevant than probably the market thinks. The size of the fiscal deficits is more relevant, and the tariffs are more relevant. Basically, if we're going to have, 400 plus billion in new taxes this year, that's a bigger variable, I would say, than 50 or even 100 basis points from the Fed. You have to get into a lot bigger hikes or cuts to really start having an impact of that scale. There's different types of yield curve control. During the height of the pandemic, the lockdowns, the Fed openly talked about yield curve control in their meeting minutes when they were kind of stabilizing the bond market. They dropped that. They didn't have to go that route. Right now we see kind of talk about politicization of interest rates. That's not new. For example, in the prior administration, you had Elizabeth Warren. She was on the Fed's case about trying to get rates down. And now we have the Trump administration on the Fed's case trying to get the rates down. But I do think that one of the outcomes of fiscal dominance is you tend to get less separation between the government and the central bank, because the central bank, whether they like it or not, generally has to step in and put out fires. An example of that is when the Bank of England had the gilt crisis in 2022. So they announced a budget that had a bigger than expected deficit. They're not the reserve currency, so they have a parliamentary system, so they're a little bit more volatile with some things that happen. And basically their gilt market sold off. They had leverage in the market that kind of resulted in more sell-offs. And so the Bank of England, it's kind of comical. So inflation there was like 10% at the time. They were going to start balance sheet reduction, quantitative tightening, and they had to cancel a conference about balance sheet reduction to instead go and buy gilts to put out the fire. Now, once they put out the fire, then they eventually got to, a period of quantitative tightening as they planned. But the point is they had to drop everything they were going to do and buy government bonds with new kind of temporarily printed money to put out a fire. And that's generally what happens when you start to get more toward fiscal dominance. And in the US's case, we have a situation where the Treasury has been more active in what they're doing. So, and other things started under Yellen. So far, it's continued under the current administration, which is that they can do things like shorten the average duration of their debt. They can issue a higher percentage of their debt as T-bills, which is where there's more demand for it. Rather than term out their debt, they can refill their cash balance less quickly than they might otherwise would. They have different levers they can pull that are, in some cases, roughly equivalent to a handful of interest rate cuts or a little bit of quantitative easing, for example. But basically, you get less independence. If you look at the New York Fed's annual report on the state of their kind of securities book, they plan in roughly a year to go back to gradual balance sheet increases. They probably wouldn't call it QE at the time unless there is a recession, but they'll be ending their period of quantitative tightening and go back to gradual increases in that. Whether we get outright yield curve control, that's a very politicized thing to happen. And it's hard to do without a major acute crisis. So for example, when it was done in the 1940s, it was World War II. So nobody was looking at treasuries. They're all looking at what's happening in the Pacific, what's happening with, Europe. There was a very kind of raw knit together culture at the time. It was a very centralized culture in a way. We don't really have a reason. It's decades of kind of bad decisions have caught up to us is the answer. And we just kind of gradually build up this really big debt burden with interest rates that aren't going down anymore. So we need to do yield curve control. That gets really sloppy. So I think they're going to try to push it off. But I do think that there could be various kind of yield suppression techniques that keep it somewhat below what the market might otherwise settle at.